Hello, welcome back to Global Weltrade Synthetic Signal Provider Service. If this is your first time of visiting this YouTube channel, do your best to subscribe and turn on the bell notifications so you get notified each time I upload a new content. Try to like and refer this channel to your network so that YouTube pushes to a very high level of audience. In today's topic, we shall discuss stop loss optimization for fast infinity profit generation. Stop loss optimization for fast infinity profit generation. Stop loss optimization for fast infinity profit generation. Okay, you see, a lot of traders actually got good opportunity, like they actually input heavy amount of effort, like they actually put 100% of dedicated and committed action to get the right trade, but at the end the risk reward is actually poor, maybe due to fear, maybe due to fear of drawdown, maybe due to other psychological issue that can make you actually get less from the right trade. When you get a right trade, you are going to optimize your profits, because when you are losing your capital, you are not losing your profit. Okay, you are actually losing your capital, but whether you lose capital or you lose the profit you have already made, all of them is losses. And in this video I'm trying to teach you how you can actually take advantage of good trades, so that when you lose, those good trade is going to make those losses as if they do not exist. Okay, so if you are trading $1,000 account or $10,000 account and you are on a loss of, let's say, $1,000, and then you make a profit of $5,000 on a good trade, is reasonable, because you are running on a net income of $4,000. But if you lose $2,000 on a $10,000 account and you just made $500 profit on a good trade, you know that this trade is good. This is push it, because maybe the next trade you think that will actually pay is going to lose more than previous losses. Why is it going to be like that? The reason is because there are a lot of forces that make you as a trader to lose more money. So the odds is working against you. So if you manage to get a good trade, you should learn how to optimize for that good trade. So in this video I'm going to teach about this optimization, but that doesn't mean that you should not take your risk management serious. You should take the risk management serious. Like, you should manage your profits, you should manage your capital. But the main thing, the main thing about this optimization, like the reason behind this topic, is not to ignore the risk management, but is to ensure that when a good trade comes up, you are able to get high risk reward. Because there is no point of placing a trade on a good signal. There is no point of entering trade on a good setup, and at the end the maximum drawdown you saw on that trade is far from the maximum drawdown you set. So if you assume that a trade, if you risk $200 and you assume that the maximum drawdown on this trade is going to be around $100 before it starts stabilizing in profit direction, and suddenly you notice that the maximum drawdown was not up to $100, maybe it was around $30, it means you have actually wasted pips and loss size. It means you have actually used you have actually used a loss size that is not what you're supposed to use, a loss size that is lower, making you to make small profits on a good trade. And what it means, if you make small profits on a good trade, psychologically you are going to be affected spiritually. You are going to be affected, and you are going to look for a wrong trade. It's not that you want to look for a wrong trade, but the circumstances, when you actually sit back and you saw that this trade actually went well, even when you have been even when you have exited the trade and you see the market still move and the drawdown is not much, and then it will actually make you to be much more pushed to look for another trade. And at that level, you are no longer with yourself. You are not being under control of what has happened in the past, which is not good. And then you want to revenge the market, and so you meet another loss. So you lost $2,000 before. Right now you lose another $3,000. Your $10,000 is down to $5,000. So when you get a good trade, plan a trade, make sure it's the right one, and then try to follow what I'm going to teach in this video for optimization. Okay. Right now, if you are following this channel and you are not using our broker, or maybe you have actually registered with the broker that we have recommended, which is Weltrade Broker, make sure, I have a reason for saying this, make sure you use our link in the description of this video. Make sure you use the link to register for Weltrade Broker. The reason is because there is a lot of disputes. I have a lot of followers, subscribers in this channel who complain to me about how they are having withdrawals, like they have a kind of withdrawal discrepancy. It's not that the broker is delaying the withdrawal, but maybe because some limitation on their side, their country, the region they come from, the withdrawal get delayed, you know. So it is the work of an ambassador like us, like we global Weltrade synthetic signal provider owner, which is me talking to you here. It is my work to talk to the management of the Weltrade Broker, and they will release your fund immediately. So if you have not registered for Weltrade Broker, make sure you use the dedicated link to register. But if you have already registered, you don't need to register again, but you have to be under us. Like, you have to chat me on Telegram so that I will put you under my IB. You will be under my IB, so that if issue comes up, if there is a dispute, you are going to chat me, and then you are going to send a screenshot that prove that you are under my IB, and then I'm going to, because of that, I'm going to use my influence and solve your problem and make sure they pay. Once they know that it is me talking, because I'm the ambassador, they are going to do, like, they are going to solve the problem for you. They are going to release that pending withdrawal. Okay. But if they don't know who you are, they don't know where you are coming from, even if you have a verified account, that is not a guarantee that your fund can be released. It takes a strong hand, which is we being the ambassador of the company, because we have share with them. Like, we are part of the company, and I'm not a middleman between you and them. So I can easily solve your case because you're actually under my IB. So try to take this serious. Okay, that's by the way. Right now, let's go deep. Let's go deep into the main reason for this video. Okay, let's go deep into the main reason for this video. Take, for instance, this is a this is the vertical axis, and this is the horizontal axis. This is the time, and this is the price. This is the origin. Okay, now let's assume that there is probability of buy within this block, because in trading things have to be in zones or in regions, or like there should be limits, there should be intervals for which certain events should happen. Because of the market is a probability based event, so it have to be like that. Okay, so let's assume within this session there are probabilities of buy. So this horizontal line represents prices at which one can enter the market. Okay, and then you also design another block right under this block. Let's use red. Let's use red for this. Let's use red for this. So there is a block under here. So we are going to use this block for our stop loss placement, right? Now let's assume you manage to capture the buy. Let's say we are trying to buy this market. Let's assume you capture the buy at this price. Then you are buying this market hoping that it's going to come to this TP. There is a TP somewhere there. Okay, you don't care about the path it takes, but all you know is that it must reach and hit the TP, right? But you have assumed that your stop loss is going to be here, because you feel like, oh, if you place this trade here, it might draw down and possibly come towards here, but not necessarily hitting the stop loss, and then start going up. But maybe in another scenario, what really happens is once you place this trade here, you just draw down a little bit and push and go to TP. Okay, so the difference between an optimized SLP and unoptimized SLP, that difference is called error, and that error is working for the brokers and working against you. The error will make you to use a very small lot size, because the formula to calculate lot size is actually the lot size formula. From the formula you will know what I'm saying. The lot size formula is LOT equals to the risk in dollar all over the stop loss pip. Okay, you know the loss side does not have units, is unitless, right? So you have to multiply the denominator by pip value, which is also in dollar. Okay, the pip value PIP. Okay, so let's make this realistic. The SL pip times pip value. Okay, pip value, this pip value we can call it PV to make it more realistic. Okay, you see, dimensionally is going to be correct because the risk is in dollar, which means it has a unit of dollar, and the SL pip does not have a unit of currency, right? But it's just pip, right? It's just a count, and then PV have a unit of dollar. So for synthetic market, the p value is always $1. For gold, the p value is $10. For Bitcoin, the p value is $1. For oil, the p value is $1,000. And for GBP USD, the p value is $10. And other p values of other financial assets can be found on Google. Just ask Google about those p value, you can get the answer. Okay, if you go to mataf.net, you can get the p value of forest assets. Okay, and commodity assets like gold, metals, gold, platinum, diamond, copper, zinc, and all of that. You can get their p values. You can get the p value of currency pairs like GBP USD, GBP JPY, and so on and so forth. So that's where the p value will be. But since in the synthetic market, especially the Weltrade market, all the p value of the synthetic assets are just initialized to $1. Okay, when it comes to the derivative market, only the step index have a p-value of $10. The rest synthetic assets in the derivative broker actually have $1 as their p-value. So we can now eliminate the p-value, since actually this video is using synthetic Weltrade synthetic assets for illustration, but I think okay, let's allow PV to be in the formula, so that it will actually be deployed generally for forex market. That's cool. Right now, based on this formula, the loss is risk over SLP upon P value. Okay, you cannot see that if we allow the risk to like, if we allow the risk to vary, since PV is fairly constant, the P value of an asset is actually fairly constant. For synthetic market, it is purely constant, and it is initialized to $1, apart from step index in the derivative broker, which is $10. But for Weltrade broker and derivative broker, they are all $1 apart from step index in the derivative broker, which is just $10. Okay, so we can say for synthetic market, PV is fairly constant, is not fairly, but is purely constant. But for forex market, it is fairly constant, meaning that it is not 100% constant, but the variation can be negligible, so that we can assume it to be constant for a long period of time. Okay, but the thing is, you have to keep, because some small errors can cause heavy change, can cause chaotic change in the calculations of lot size. So because the presence of those errors, so you have to go to the website, you have to check on matter.net and to see the updated p-value, because the actual formula to calculate p-value is actually depends on the current exchange rate, and so the p-value may not be like it is fairly constant, but there will be errors. So maybe let's say the p-value of GBP USD can be $10 at a certain point in time. Maybe after 2 months, 3 months, the exchange rate goes to some value, and then maybe the p-value can go to 10.5 or 9.5. So this small change, making it to revolve, like deviating it from the actual 10 that you have been seeing on the website, it can create errors in calculation. Okay, it can create errors in calculation that will affect your risk management. Okay, so that's cool. So when you have known this formula, you will see that in profit stop loss optimization, all we need to do is to use probability analysis, high frequency analysis, which when I say high frequency analysis, I mean line chart analysis, then node and loop analysis, block control analysis. We are going to deploy this to know the actual maximum drawdown that can happen at any given price you enter the market, so that you will not go beyond it. Like, you will not add unnecessary or unwanted noise to your loss size calculation. There is no point of using stop loss peak of 100 when the market will actually draw down to 30. So if the market will draw down to 30 pip, then what you need to do is to add protection. So you know it's going to draw down by 30 pips, so you add a protection of maybe 15 pips, making it 45 pips. This time around, you have used 45 pips to enter that market than using 100 pips. With the 45 pips, you are going to use what you call an infinity profit generating loss side. Now I'm going to explain this, and so we are going to start to do the final explanation. You see, the power of the power of, you know, making sure you do your top-down analysis, it cannot be like taken for granted. Like, you see, top-down analysis is very important for you to avoid certain losses, because at different time frames the market behave differently. Sometimes they behave the same, sometimes they behave differently at different time frame. But if they are to behave the same way, maybe it could be 30% of the time, but 70% of the time the market behave differently at different time frame. Okay, look at now, this is daily time frame, right? The day is bullish and is buying, right? Now when you go to the monthly time frame, it's doing the same thing, right? When you go to the week, it's doing the same thing. So three higher time frame are doing the same thing, right? If you come to the 4 hour, it's actually doing the same thing, making higher high. But there was a time it was doing differently. So it was making lower highs. Okay, it was making lower highs and lower low. So you see, in 4 hour it was selling at some point, and now it is buying at this point, right? At this period of time, right? So different time frame can show different stuff or can show the same stuff. It all depends if you can take committed action to actually study the top-down behavior of the market. Is very necessary. Okay, so it's necessary so that this is not part of this video, but why I say this is because I want to enter the market. So I'm trying to tell you that you should do this in order to actually get the right entry, right? So I think if you are tired most of the time and you feel like, how will I do all this analysis from all the time frame? So you just check the daily, check the behavior of the daily. It's very important, because whenever you enter the market, you are entering it in a given day. Even if it's a crossover, maybe the current day is about to end and then you are entering the next day, you are still doing it in a day. Right now I'm shooting this video around 2024 GMT. It's within today being Sunday, okay, October. So I'm shooting this video right here, okay. Now when you go to 1 hour time frame, you see there are a lot of selling during retracements, major retracements, minor retracement. We can take this as a major retracement to grab liquidity, and inside this session there are retracements and there are markets that are actually impulsing to the upside, like a retracement and buying impulse and sell retracement. Okay, so let's assume that I've come to study this market in the daily time frame and I discovered something happened here. Then it left for me to understand what does this thing mean. Like, what does this thing mean? How will it help me to get an entry? This is not the only thing I'm going to study in this market, but why I mark this level is because it creates an interesting avenue for argument, right? Because some people will be like, oh, if price came here, there will be some sort of reaction. Let's see if it really happened in the 4 hour time frame. Yes, in the 4 hour time frame there is a reaction. As price is pulling towards there, it pushes back, it keep reacting. It keep writing, you know. Cause and effect is what you need to understand in the market. It may not be necessarily like the reaction that happened here may not be caused because of here, but there are probabilities of such thing happening here, so you have to take note of that. But the fact that the price in the 4 hour push up and it pushed down, but it couldn't take out this low, is a sign of buying pressure, right? I don't want to be teaching price action here, but I'm trying to teach how I'm getting the entry and how the optimization will be done, because the optimization will actually follow the way you were able to get the signal, the way you were able to get the trade. That means different setup will require different level of stop loss, pips, and their and optimization, depending on what you know about the market, depending on how you come across that kind of trade, right? So right here, I've known that buyers are in this market. So maybe I'll be like, let me enter this market maybe during the opening of the day, which means you are believing that since you are looking for a buy market, when the day open, it's good to start buying, and so you are going to be looking for a way to enter the buy, right? And if you are entering a buy market, then you are looking for a strong support to actually make your buy a reality. So maybe this is the day you wanna enter this market. This day, even though it wasn't like the volume was a bit lower, but you know that it will continue the next day to increase in volume, right? Now look at what you are going to do. You are going to study how this, because every candle have lows and high, right? You are going to study how the low is going to be formed in this day. In fact, you are going to allow the low to create, which it did, meaning that if the low creates, then it becomes stable, meaning that no matter how price move, is not coming back to that low, because that's the mechanism of price movement. It has created that low, meaning that throughout the day it's going to buy without touching the low. And when the volume is on rise in a given direction, whether buy or sell, when the volume is on rise, the lows and the highs causing the rise in that volume are not going to be interacted with, like they are not going to be reacted to, because the market is no longer pushing. Like the market it doesn't have time to wait. It doesn't have time to go and do some sluggish stuff. It's going to impress the volume. It's going to make sure that it respects that rise in volume. Okay, so that is where volume spread analysis comes in. But this is not the part of this stuff. But I'm trying to get, like, I'm actually giving you a lifestyle of what it means to get an optimized stop loss. Because for you to get an optimized stop loss is not something, you are not going to be weak. You are going to understand the market from intuitive nature. Well, right here, I noticed that this thing have formed. I'll step down to 1 hour time frame. Why my slabs are still intact? The 4 hour slabs, the daily slabs are intact. Look at what I'm gonna do. Since this slab here, this one represents the daily low range, because it's a range, it's not just a point. The daily low range, right? What I will do is I will check if there is possibility of seeing a support within that range or outside that range. So there is a support here, okay? Because the market moves from left to right, so you have to understand this. So probably I will enter somewhere here. I will manage to enter somewhere here. Now, if I'm working my stop loss, I will switch over to line chart. Then I will see the harmonics in the market. I will now discover that I'm going to change this to black. I will change this to black. Okay, I think it's black now. A bit black, so let's manage it. See, I want to enter at the black. Let's change the color of this line to blue, showing the entry price. Okay, so assuming I'm entering at this blue, but this is my entry price, right? Now, if this is my entry price, I will shake blocks that will control that entry price. So you see that this block is there. So why I use this block, you see why I use this block, this black slab shows that no matter how price struggles, it will not attack the lows of this black. It will never attack the lows of this black. But in reality, when you are doing line chart analysis, there is the stability in line chart domain is they have a lot of instability. So when you assume that a block cannot be attacked, then that is an assumption. It's not real. A block can be attacked. The market can still, in the line chart domain, the market can still come and attack this block and then push up. That's why you need to do everything necessary, which will include candlestick analysis. So right now I will switch over the candlestick. Then when I switch over to candlestick, I discover that there are tendencies that price will tap into these lows. You see those lows, price can tap there and create liquidity. So I can easily give it a little bit space. Then you see that my SL can be here for full protection. It can be here, and my entry is there. This is over 1,669 p. It's too much. It's too much, okay? But it's better than entering this trade here and putting your stop loss somewhere here. Here you are risking 3,000 than instead of you to risk 1,600. Then if you want to make it more optimized, like if you want to get more, like if you want to, because the optimization here is to reduce the stop loss peak, like to make it to go back to zero, like to make it to approach zero. That's the main purpose of this. All right, now when we have 1,600 pip, it's still too much. It's very far from zero. It's very far from 100. It's very far from 1,000, right? So how do we solve this? It's a very big problem, right? Now to solve this problem, we can shift to some lower time frame, like 30 minutes, and then I'm going to delete everything apart. I'm not going, like, I will not delete my entry price, but I'm going to delete everything else, okay, apart from my entry price. Okay, we are going to leave this one so that you can use it for illustration. Okay, we are going to leave the arrow for illustration. Now here is our entry, right? We have marked here to be our entry price, right? Now look at what I'm going to do. I will, since I want to buy, I will check where the market sold and buy multiple times, and I will represent it with a structure. Like it should be a group action. It should not be just one. Like it should be a multiple action being modeled by one single element, which is a trend line, right, or a horizontal line. So I have here. So what do? My belief system is, no matter how price struggle to behave, once it touch this line, is not going to have a drawdown. That means the drawdown is going to be zero, and it's going to move straight to the point, to the upside, right? It's going to move straight to the upside. So what I do is, instead of letting my entry to be here, I will optimize the entry to here. So you can see, by optimizing your entry, you can actually make your SLP to go to zero. Now when I do this, the next thing that will come to my mind, what is a nearest buy price to this entry price? What is the nearest buy price? I discover now that the nearest buy price is this, right? Now in theory and by law, no matter how the market struggle, it is rare for the market to a trending, because it is, you have to do this in a trending market. It is rare for a trending market to react back to prices that it have left, right? Now with this theory in mind, I will not say that price we find it difficult to interact with this session, right, then I will take the midpoint, no matter how it's struggle. After all, I want to make it big, right? Even if I'm taking out, right, I will re-enter again, maybe with a kind of adjustment on the SLP. But if I wasn't taken out, I'm sure of this is a great risk reward, right? And you see, this idea will make you to risk small amounts of dollar in order to get big. That's cool. When you have multipliers of times 100 times 200, then why should you risk big? You don't need to risk big, right? I think the essence of trading is to make profits, and one of the ways is to take advantage of a good trade by optimizing your SL. So you can see at the midpoint we will have 100 pips. So 100 pips to target, because when you go to higher time frame, you know that here should be your take profit. Yes, first take profit, second take profit somewhere here, which the market have smashed. So when you enter here, you are cashing 5,000 pip on a 100 stop loss pip. So when you run the math, so right here, when you run the math, you discover that you are risking 5,500. You are generating 5,500. That's your generating your profit generation, your profit pip, like the profit, the pips that will give you profit, and then you are dividing by 100. So the risk reward is 55. If you are playing a Viator in a football bookhouse, like in a betting site, you notice that in most cases, depending on the period of the time you are playing the Viator, okay, and the probability for your the probability distribution at that session, you can get multiplier that are of bigger order, like 2 figure, 3 figure, 4 figure, 6 figure, 5 figure, 6 figure, and thereabout and more. Okay, then there are period where the multiplier will go to 1. Maybe that the multiplier will be less than 10, from 10 to 1. And in such cases, many people are losing their money because a lot of people want to get it big, right? But that's cool. So what I'm trying to say is, you have to see market as an aviator, whereby you are looking for the best odds, you are looking for the best trade, you are looking for that best odds, and you are trying to optimize your asset, not making it too big or too small, but making it normal, but in such a way that it tends to go close to some small range of stop loss pips, so that there will be a sudden rise in your loss size. Okay, because at this level, when you have a risk reward of times 55, and then you see that you are using big loss size, because even $10 will turn to $550, and $100 will turn to $5,500. You're actually using small. You're actually using big loss size. An example is, you have $100, and then you divide it by 100 based on the formula. So you are using loss size of $1. But if you had stocked to 1,660, you are going to have a loss size of 0.06. This is bullshit, because if you calculate the error, 1 minus 0.06 is around 0.94. So 0.94 divided by the accurate measurement times 100, you have fucking 94% error. This error, when deployed in certain equations that guides, that models how money should be made in the market, you see that you are actually making money, but that money will be lost when you have big losses. But when you make big money and you lose some, you will not notice those losses. So that's the essence of this video. Thank you. Make sure you are proactive. Subscribe to our VIP channels, enroll for our courses and mentorship, and make sure you invest with us. Like we do a lot of stuff in terms of account management. We actually pump money into your account, and it's on 50-50 deals, like 50% to us as managers and 50% to you as investor. Thank you, and bye for now.